live. We are live. This is Senate Finance on February 5th. And today we're going to walk through S-282, and that relating to increasing taxes on higher income earners and creating the school construction aid special fund. This was the one where things that are tax exempt federally would be added back in, be taxed here, mostly having to do with investment income as much as I could understand it. And so this is going to be 101 to help us figure out what we're being asked to tax, what it would look like, and how much money we might make at it too. So Kirby, I've got you first. If that's
I think that's good.
okay, I think if you guys think the order should be turned or changed at all, just change it.
Yeah, I think that's how we, so Kirby Keen Legislative Council, the way that Pat and I split it up, is that I'll walk you through kind of explaining, doing a deeper dive on what's being proposed. And then Pat will supplement that with a little bit of info about revenue to the extent that he can.
Okay.
Yeah. So again, Kirby Keaton, Office of Legislative Council. I have presentation for you now. So in S-282, there's a proposed wealth proceeds tax, is what it's called.
Okay, right.
It's based off of and adapts something called the net investment income tax. That's a federal tax that exists and has existed for a while. So we're gonna go through the net investment income tax first to get an understanding of that. And then we'll talk about what the wealth proceeds tax is doing using that. We'll compare the two, and then I'll go over just some decision points at the end to make sure that you're aware of them. So, you know, this net investment income tax, federal tax that's existed for more than 10 years. It's not something that I've crossed paths with, something that seems to come up very much, but there it is. It's a federal tax just sitting there.
First time I've heard of it.
So some background. It was part of the Healthcare and Education Reconciliation Act of 2010. It became effective in 2013. This was during the Obama administration leading up to the Affordable Care Act. And so it relates to those things. Its purpose was to help fund healthcare reforms through the Affordable Care Act. Side note, it does go into the U.S. Treasury General Fund, though. It doesn't go straight to Medicare or something like that. But that was why it was made. And there's been a little bit of history because the Tax Cuts and Jobs Act eliminated the individual mandate that was part of the Affordable Care Act, but it did not touch this. It left the net investment income tax in place. And at the federal level, it's called a surtax. You know, sometimes we've talked about surcharges in here, which is the same thing.
Yeah.
It's a tax that's on top of another tax. So in this case, this is an income. It's on top of the personal income tax at the federal level. It's an additional tax on income from investments. Anybody have any questions about that stuff before we go on? Okay. So just to help contextualize this, because I know we're all like getting to know it, don't take this slide as any sort of advocacy. I'm putting what ITEP has said is the reasons for taxing this, the reasons why a wealth proceeds tax would be what they think is a good idea. So number one, on their website, I would say go to their website if you really want to see the full pitch, and I'm just giving some context. They say that there's some tax disparity because earned income from work is often taxed more than passive income from investments. I can support that long-term capital gains and qualified dividends, federal level, have a lower rate often than wage income
Okay.
at the federal level. which
So this is taxed now because of the,
This is just like their reasons for thinking that taxing this investment income is a good idea.
okay,
They also say, it's part of progressive tax policy because individuals who have a lot of income tend to have a lot of investment income.
okay.
So moving on, that's just to contextualize things. Let's talk about the tax base and the calculation for the net investment income tax at the federal level. It's a tax of 3.8% that applies to the lesser of net investment income, which we're going to walk through everything that goes into that,
Okay,
or the amount that your modified adjusted gross income exceeds certain thresholds that are set in federal statute. For an individual, that's $200,000 which is modified adjusted gross income.
okay, so this is a present existing federal tax.
Yeah, right now, we're just talking about the federal tax.
Okay.
So you can understand that before we move on to the other part. To give you some examples about what this means, let's say just completely hypothetical individual who inherited some song royalties and they just live off that. That would be investment income. They're living off of the income that comes from some royalties. Maybe their grandparent was a famous musician, something like that. They would have all of their income would be net investment income. It would be all that royalty income. But let's say it's $150,000 a year and they live on it. Under this, the MAGI threshold, the modified adjusted gross income threshold, is 200,000. They would not pay this because it's the lesser of the two, and their modified adjusted gross income would not exceed 200,000, so they wouldn't pay this. Let's say you have a doctor in Vermont who earns $400,000 a year, but they have retirement accounts, but they don't have investments. They would not pay this because they wouldn't have any net investment income to apply it to. If that same doctor had, say, a small amount, like 10,000 in investment income, that 10,000 would be taxed at 3.8%. So here are all the things that go into that investment income. Again, this is the federal tax base. First, it's income from capital gains, short-term and long-term, doesn't matter how long it's held. All capital gains are included. Dividends, in parentheses, I've kind of, explained what these things are in a short way. Taxable interest, so the interest you get from a savings account or bonds. Rent and royalty income, I mentioned royalties a second ago, which is income from intellectual property, but also income from real and personal property would be rent. Passive income from investments. Passive income means that the taxpayer is not actively involved in the business.
Would that be your IRA? Would that be like your IRA?
Like a retirement account?
Yeah.
No. This is like business type income where you just invested in it and you're just receiving income from that investment and that you're not actually running the business.
So 401k, 403b, which
No, and I'll show you all the things that are not.
Got it.
And those are some of the things that are not. What is included is business income from trading financial instruments. That is when you're doing short-term stock trades. And you've set up a business to do that because this is business income. For an individual, if you just sell some stock, that could be a capital gain. But there's this subcategory of actual traders who set up and it goes down as business income for them instead of capital gains. So for that stuff's included, the income from that. And then the taxable portion of a non-qualified annuity. This is when you go to an insurance company and set up an annuity and you're receiving income as that money grows. So those are the types of investment income that the net investment income tax applies to. Not included. Wages, Social Security benefits, unemployment pay, qualified retirement plan withdrawals like the 401k or the IRA. Many different types of retirement systems with defined benefit plan, deferred compensation plans, interest from municipal bonds or funds, income from the sale of a primary residence, life insurance, and then active business income is also excluded. If I'm going too fast, let me.
So far.
Okay, great. All right, so now we can talk about modified adjusted gross income, because that's something that's used with these thresholds to determine whether a taxpayer has to pay this. Modified adjusted gross income is something that's used all throughout the federal tax code, and it means different things in different places. So when we talk about it here, it's pretty simple. It's AGI plus, if you've used the foreign earned income exclusion, you have to add that back. So if you're a US citizen living in Paris and you can exclude up to 130,000 of your wages that you receive from your job there in Paris. That gets added back for this, but at the same time, all the deductions that you don't get to take because you took that exclusion, such as taxes paid to France on those wages, you get to include that. So basically, for most people, it's just going to be the same as AGI. The exception being if someone has foreign earned income and they've excluded it. Okay. So what are the thresholds? I hinted this before. For a single individual, 200,000. That means I'll show you again. But for married filing jointly, it's 250,000. And for married filing separately, it's half of the married filing jointly, and that gets applied to this, where we look at the amount that MAGI exceeds the thresholds. So if you have modified adjusted gross income less than those numbers, you would never pay this. That's probably why so many of us haven't heard of it. But if it exceeds it, then possibly you start paying tax on net investment income if you have any. Some notes here. These thresholds were set at 2013 when this first became law. That hasn't been changed. There's not an inflator associated with these thresholds.
Okay, so 200,000 in 2013 was worth more than it is
Yes,
now.
that's part of why I'm noting this, is to tell you that.
Thank you. I was gonna say, that sounded fairly low if this was thought of as a wealth tax.
Just so I get it right, you have a single income earner making 225,000. 10 of that falls into the net investment bucket. Just that 10 grand is 3.8%.
Correct.
An
Additional.
additional 3 point.
Yeah.
Yep.
So you pay your regular income tax all the way up to that 225, and then you get an additional 3.8 on that 10,000 or whatever the portion is.
Absolutely correct.
And then, okay.
Thanks.
Yeah, thanks, Chris.
Thanks.
Impressed.
Just had to say it out loud.
Yeah, I know, it's helpful.
Okay, so now that we're understanding how this federal tax works. Oh, I gave some examples on the next slide.
Oh, shoot. Should have waited.
Shoot.
There.
It proves you knew it.
Yeah.
Yeah.
So some examples to help understand it. Let's say a person has $50,000 in net investment income and modified adjusted gross income of $300,000. They're a single filer. That means their modified adjusted gross income is 100,000 over the threshold. So in this case, the lesser of would be the 50,000 in net investment income, and that's what the tax rate would be applied to. And it would be $1,900. Okay, so now we're gonna leave the federal stuff. Everyone's got that, right?
Got it.
Mhm.
We gotta make it a little bit more complicated when we bring it to Vermont. So, just some high level things to know about the wealth proceeds tax. It adapts the federal net investment income tax to Vermont law as a surtax on a similar tax base. It's a tax on certain types of income that is in addition to income tax, which I think everybody gets that. It does not directly tax the value of a taxpayer's wealth. So I think we've had in recent years some proposals to tax wealth. In that case, it's taxing the value of assets.
Mhm.
And I think people's minds could go there. So I just want to make it very clear that that is not what this is. This is not income.
Unrealized is the example.
When people talk about unrealized gains, yes, this is on income, it's realized gains.
You have drawn it down.
You
In your fund,
receiving, yes.
not in an account being reinvested.
There's one instance of something we're gonna go over later that's unrealized, but
Okay,
yeah, but that's the way to think about this. It's about income. Okay. So the wealth proceeds tax is as proposed is a 4% rate applied to the lesser of wealth proceeds, which is that net investment income base we talked about before, but there's several adjustments that we're going to get into. Or the amount of modified adjusted gross income that exceeds the thresholds. And for the way that this is proposed, is the same thresholds as we were just looking at. There's a couple of places where when I'm going through this more thorough review after drafting that I would like to go back and draft better. Just I'm going to flag that. One of them is that there are some references to Vermont taxable income in the imposition of the tax. Looking at it with fresh eyes doing this, I think I should go back and do that and take that part out because it kind of confuses things.
I think it's safe to say we're not gonna vote this out.
Right. Yeah.
Yeah.
So just
Well,
what I'll mention again later there's some other stuff that I want to polish it. But
So this would be 4% on top of the 3.5% at the federal level, so it would be a 7%, 7.5%.
it'd be almost 8.
It's 3
Almost
plus
8.
4.
Yeah, so 3.8. Yeah.
Okay. Yeah. Okay,
Okay, so what is the wealth proceeds tax adding in addition to the tax base beyond what we already talked about with the investment account? For one, it proposes to increase the tax base by adding income from state and local obligations outside of Vermont. That's bonds from other municipalities or states. This is something that's not included in the federal tax base because it's exempt federally, but states are allowed to tax this income, and Vermont does for the income tax. So it's adding that back. Second, gains from qualified small business stock is excluded under federal law. We've talked recently about the federal changes from last summer from H.R. 1 that expands the amount that's excluded at the federal level for gains from qualified small business stock. So I think this part is in response to that tax policy at the federal level to get some of that back for Vermont, so to speak. Same thing goes for the third bullet there, which is the gains from investments in opportunity zones. That was another area where under H.R. 1, it was expanded federally. And this is an attempt to
and
get
that would
some-
include the opportunity zones in Vermont.
Yes, investments into those. Yeah. It also proposes to increase the tax base with capital gains from the disposition of property held in a trade or business and not subject to the net investment income tax. So this would be some of the gains from a business, from running a business. The NIT kind of draws the line at passive income and active income, but this would be including some of those active gains back.
We talk like property as in like personal property included, like during this, like
it could be,
sell a piece of equipment.
could be, it's, yeah. So obviously, and I'll go over this later too, but I'll just go ahead and. These are all policy decisions for you, obviously. These are all different discrete things, whether you want it to be. If you want to go forward with this, whether you want it to be part of the tax code.
Can I follow up on Senator Match's question? If it was a piece of equipment, say you run you're selling a dump truck or something that you no longer need. What are the capital gains on that? Because usually you would sell it for less than you bought it. So what would be the capital gains on selling a dump truck for less than you purchased it?
Yeah, that I wouldn't want to answer that off the top,
Okay.
because that's,
Just trying to figure out how
yeah.
the disposition of property. I suppose if it's land and it increases in value, then like if you have
Yeah.
a piece of property that you're selling, but usually for equipment, it's depreciated, and so you're not getting capital gains from equipment, generally speaking.
Yeah, so I'm just answering, hypothetically. When I
Okay.
say, but facts of every situation is going to be different.
Okay.
Yeah. I would also note that as far as like the policy reasoning behind any of these inclusions, I would, I
Go
think
to the,
we have public assets involved. I think we have, ITEP. So getting some further testimony on that, is a good
We'll
one.
have
So I'm not gonna be able to.
probably the public accountants, and they have a association. Whenever we've done these kinds of things, we've had them in, talked about what it
And we'll-
might look like in the real world.
Exactly, and
Yeah.
we'll be getting to some other things too
Yeah.
that would require some testimony, we'll see.
This one has a ways to go, but get your head around it. Okay.
So others, we have more additions, that are being proposed with the wealth proceeds tax. So any amount of gain that's not subject to the net investment income tax from the disposition of a partnership interest or S corporation stock. That's an exemption at the federal level, and it's being proposed to not allow that exemption here. Something called net unrealized appreciation in securities of an employer, corporation, and certain retirement accounts. This is when, for example, when an employer sets up a trust for an employee and puts its own, let's be a C corporation, putting its own stock into the trust for the employee. The appreciation in that stock, by adding this back, you would tax the appreciation in that stock, even though it's,
What if the stock depreciates the next year? I don't know.
you would have it, yeah, you wouldn't have
I
a gain.
feel
It
like
says
that's
net,
just-
it says net, so
Net.
it would take, it's you'd subtract the depreciation of your stocks from the appreciation. Do you have that, right?
We're gonna see.
So non-account.
Yeah.
Um,
I mean, it could be worth a
But-
lot, one, that's always been a problem. Your stock to be worth a lot this year. If I draw that money out, it's income. But next year, it might be worth half of what it's worth this year, and so
mhm.
These are specific things, though.
Yeah.
This is a security of an employer corporation in certain
Yeah.
retire. So this is a specific thing. So there
Right.
must be some
But I-
definition of a net unrealized depreciation.
It's, yeah, these niche scenarios that come up where the net investment income tax is not taxing it.
okay.
But other places in the tax code for income tax purposes, they're taxed. And so I believe that it's being asked to be added back here because it's sort of a why not? It's a gain. It's not a traditional retirement. But again, I think getting testimony from folks advocating for this, they would be able to describe why they want this better than I'm gonna be able to do.
Yeah, I don't wanna have everyone over the age of 65 sending me emails because I'm taxing their retirement account.
That's not.
We did that once, upping the investment estimate income for retirement.
It's, yeah, this
Yeah,
is,
homestead
these
property.
aren't the traditional types of retirement.
Yeah,
This,
okay.
this is like a corporation sets up a trust for their employees.
Okay.
It's not something that's, from my experience, it's done that often. And then last of all, the proposal is to include in wealth proceeds, the income that's from an incomplete gift, non-grantor trust that would be subject to federal income tax if the trust was a grantor trust. I'm going to try my best to explain this issue. This is an issue that exists outside of this context. This is a potential state income tax avoidance issue. A grantor trust is a trust that a person can set up where they're putting assets into the trust, but they're keeping some control of the trust. That's the grantor trust part. The grantor is the person forming the trust, and they're keeping some control. The way that works for tax purposes is the income from that trust is treated like the grantor's income. So if that person lives in Vermont, they're taxed like they live in Vermont. Through some tax planning, you can set up a trust in a different state that doesn't have income tax. And the grantor can give up some control of the trust, where the trustee, the entity running the trust, gets more control. And that's when you can have something like an incomplete non-grantor trust. Tax wise, since some control was given up, it's not treated like the income from that trust is not treated like the grantor's income. Vermont would not be taxing it in that case. It would be taxable in the state where that trust is. It would be the trust's income that would be getting taxed. So you can see that this is something that a person can use to avoid, especially if they're in a state that has a relatively high personal income tax. This is something that could be used
Right,
so
so
that they're not
in
paying.
state 30 miles, 40 miles to the south, that has no.
Mhm. And, lots of policy arguments here, because when you set up a trust, you can be beneficiaries. So maybe it's not the grantor that's benefiting from that income anyway.
Right.
So there's, and also in the language that's used to set these trusts up, I think there's some legal debate about if it's really truthful, like if the grantor really doesn't feel that control. So there's a lot there. Point is that this is an attempt to look past that and say, if this would be taxable as a grantor trust at the federal level, then we're going to apply the wealth proceeds tax to the income from that trust. The things that are being taken out of the tax base by the wealth proceeds tax are things that you would legally have to do. So there's not a lot of policy decisions here, but Vermont cannot tax income from U.S. obligations like bonds, certificates, things like that issued by the federal government. And then there's also the provision of any amount exempted from state taxation by the U.S. law. I was trying to come up with an example for you. I didn't come up with one. I was thinking about like diplomats, like we can't tax foreign diplomats, but when are they going to have the investment proceeds that are sourced back from Vermont? I mean, but these are rare situations, but these are things that Vermont. So there's a table. When it comes to individuals, at least this is the comparison. Really, it's not that complicated. Wealth proceeds tax. The big difference is it's adding those individual items to the tax base. That's where I think the policy questions for you mostly lie. I was going to also just briefly go into trusts and estates, and in the process of reviewing the language that I drafted for this, I realized this isn't coming together like it should. So this is another area I would want to polish to make sure it's very clear how trusts and estates will be treated. But assuming that the General Assembly would want to follow treatment similar to the net investment income tax, like this already does for individuals, it would end up, after some drafting changes on my part, it would end up being applied to any undistributed net investment income that is, if that income has been passed out of the trust to beneficiaries, then that will be distributed. So you don't look at that, you just look at what's undistributed. And the tax would apply to the lesser of that or the excess HEI of the trust, or say over a certain amount. Under federal law, it's set at the highest tax bracket for trusts. I'm not sure that that's a great thing for Vermont to necessarily link to, because we don't really link to the federal brackets like that normally. But there could be a policy decision there for you, whether you want to set a Vermont's highest bracket, but keeping in mind that those brackets are not modified adjusted gross income, they are Vermont taxable income. So it's a little bit apples to oranges. So if you did that, it would be $15,200 of Vermont taxable income would be the threshold. For states and trusts, the thresholds are the highest bracket is quite low number. Or you can set it at an amount of HEIs. So just some considerations to make you aware of. Clarifying language is needed. I've talked about that. I've also talked about how, a lot of these policy decisions are coming down to, which of these additions to the tax base do you want to include? I've also mentioned that I think it's a good idea to get testimony on those. I think that at least when it comes to the grantor trust issue, that's a greater tax avoidance issue. Could be something that you might want to get a testimony on from people with experience with that. And then the last thing that I haven't mentioned is staff, we need to do some more work on the allocation question. When it comes to the federal tax and this net investment income that happens, it's happening in the US and it's being taxed in the US. We have the extra wrinkle when it comes to our income tax, it has to be allocable to Vermont. We can't, we don't tax a capital gain that's the sale of a house in California. So learning more about how many of these things can we actually trace back to Vermont is really important to know what can Vermont expect as far as the revenue.
Okay.
So for assets that are located in Vermont, that's fairly easy, but in other things, it can get tricky. And that's something that we're continuing to look at.
Okay. Any questions at this point? I think, good job. We have a long way to go to get our heads around.
Yeah.
We will get some of the practicing CPAs to come in to actually fill out these forms and see if they can help us.
When it comes to the trust question, I think, attorneys who do tax planning, I think there are some firms in Vermont that do that kind of work. And,
One here.
ITEP has testified before, and I know they've put out a lot of information on this issue that drawn attention to the tax avoidance issue. So,
Yes.
Thank you. Kirby, I don't know if you have an answer for this, but there's so many qualifiers above and beyond the income threshold. Do we have a sense of how many people this would apply to or anything like that?
as far as how many people that would be subject to this in Vermont who actually are above that modified adjusted gross income threshold. Yeah, I think, or at least
Well,
something close, but it's PAC
Okay.
should have said that.
We got numbers coming up in the tax department.
Not my area.
Okay. Any other random chicken
Just
questions?
just an observation is that somewhere in all of this, we need to, I think, include a economics scientist or psychologist rather. Because the thing that we're really concerned about, as much as anything else, is as you raise a revenue of a certain kind, what's the human behavior of the person who has that revenue when you kind of apply it across a group? And what are the things that you do that actually cause your revenue not to increase as much as you want, but at some point to decline? And there's a point at which you tax people, particularly who are more mobile than others, in which you don't get the increase that you want, and in fact, you get a decrease. And the second is there's kind of a myth about dollars in that we don't apply the rate of inflation to them. And when you have people who have dollars that have depreciated because of time, the calculations that you can do, probably less so those on a year by year basis, but those that involve capital gains, in which you can. You know, you buy something for X amount 30 years ago, and you have this huge amount that you have now, and you think you've made a lot of money, and in fact, you conceivably have lost money. And then when you tax on top of that, at least go to people who figure it out, who have accountants smart enough to figure it out, you're really doing damage.
And the first thing that struck me was that $200,000 starting place. I think that definitely needs to get adjusted to what 200,000 in 2013 was a lot more money than it is today. If you look at money as buying out what you could purchase for, you could buy a house for $200,000 in 2013. Can't do that anymore. So we will see where this goes. This is our first walkthrough on this one. We are going to be walking through it a lot. But I think maybe we'll have Pat up. We'll see how much money we're gonna make out of maybe.
Impression.
In real dollars.
So back to going to fiscal office, boy, am I getting disappointed.
Maybe it isn't worth the effort.
Well, let's see. I think I can comfortably say, the revenue for this is on the order to tens of millions of dollars. To give you a little sense of where I'm at with it right now, though, the sort of low and high end of my range right now is about $40 million apart from each other. And some of that goes back to things that Kirby is talking about, and we're working through with our colleagues at the tax department, is the question about apportionment. And also some expectations of behavioral changes. I guess just to give you one sense of like this lump of money that we're talking about, is about 58% of it is, this was cited in the ITEP report, 58% of it is from capital gains. And capital gains is probably the source of income in this bucket that people have the most control over in terms of timing their sales. So that's one thing we're thinking about when working on this estimate. I did think maybe I'd just give you a little profile of how other states treat this investment income. So
Be helpful.
yeah, so for the majority of states, and Vermont is one of these, investment income is treated as ordinary income, and it's just subject to the personal income tax. Regular brackets, which is counted as income, taxed that way. There's, I believe, 6 or 7 states that actually tax investment income like this at a lower rate than ordinary income. And I think that's really more of them mirroring the federal treatment, where at the federal level, they do tax this income. I'm specifically talking about capital gains right now, at a lower rate than they do earned income like wages. And then there are 2 states that tax capital gains at a higher rate than ordinary income. One of them I don't think should really count because it's Washington, and they don't have personal income taxes, but they do tax capital gains. And then
Is it-
Minnesota,
Oh, it's Washington State.
Washington State, yes.
Uh,
And then Minnesota currently is the only other state, or it is the only state that has a net investment income tax. They just implemented it though, so there's not really a whole lot of information we can glean from them at this point in that process. But their setup is different too. It's the income threshold is over $1 million and it's 1%. But
And that's total income. We're
Yeah, so the
200,000, if we go to our top
Yeah.
bracket, we're 300 plus or minus.
the income thresholds Kirby was talking about, the MAGI, that he was talking about, just replace all
I'm
those
still
numbers.
into major, so
Yeah, so just replace all those numbers with 1 million, is the threshold on that.
okay.
Um,
And Washington State taxes investment income, but it doesn't have an income tax.
they don't have a personal income tax, but they do tax capital gains at a rate of 7%, and they may have just added a higher 9% above 500,000.
In
Yeah, that's
capital gains, not in income.
correct,
Yeah.
correct, just capital gains. So yeah, so those are the 2 states that tax capital gains at a higher rate than
Yeah.
just their ordinary income. So yeah, Minnesota is probably the most analogous setup, although some of the numbers are obviously different, 1% versus 4%, 1 million versus 200,000. Yeah, so trying to think if I haven't touched on anything. We are still, I'll just reiterate, we need to do a little more work with the tax department to work out some of the treatment of the income in terms of apportionment, and how that would be administered, because there is some potential, because we are state and not the feds, there to be a lot of leakages compared to what we see Vermonters paying at the federal level for the NIIT. And actually, Senator Gould, to answer your question from earlier, from the IRS, I was able to glean that about 12,000 returns with Vermont addresses on them pay this tax. Now, the small caveat of that is they don't necessarily have to be Vermont resident to put the Vermont address on the tax return, federal tax return. So that's just one, with the data that we're working with, one little quirk, but it's not 12,000 returns the Fed say will make this.
We're not. We might make tens of millions. If we upped that base income to, I'd like to get that top tax bracket up somebody 500,000, but up over, because I'm going to start taking some testimony out next week after, on our tax burden and what it's doing to recruiting professionals that we need, because when we said that, $294,000 was a lot of money, and it isn't that much money anymore. 200,000 is 2 teachers in Chittenden County. It's not really want to discourage coming here if they can work in New Hampshire or New York. So
I think we also need some testimony on the behavioral side of things, and there, to get that in particular, private accounting firms. And so
Well,
to get, you know, the experience they've had with, high net worth customers over the past X number of years and what motivates them to change their tax home.
I'm gonna ask, I used to be in this building a lot, but there is a CPA association.
Mhm.
And I think we'll ask them, if you know anyone knows anyone that might do that.
And then there are also firms like, for organizations, on the other side of, the, economist field. We have a tendency to, you know, deal with the ones here who generally are much more left leaning, and there are others such as the tax foundation that tend to be more right leaning. So you get
Yeah.
at least some balance in the information that you get.
And we have had the tax.
We've had the tax foundation
So we-
previously, yes.
Yeah, we will hear
Yeah.
from all sides of this issue.
Yeah.
Before making I think at this point, we're just wrapping our heads around what it is and what maybe in a best case scenario we could hope to make. Then we can start talking about adjusting numbers. I think that 200,000 from 2013, given inflation rates, is probably something we want to look at. And we can look at the behavioral aspects, and we'll look at, you know, people that do tax preparation in, and ask them, you know, what they've seen, in that. Maybe we could even find, have preparers in Minnesota and ask them, you know, I don't know how long their taxes been in place, to ask them.
They passed it in 2024, and this tax season was the first time administering.
Okay, so they haven't had it in Massachusetts. It does take a while for people to pack up and move.
Think how long it took us to get the administration of the payroll tax coming.
That's true.
That
Yeah.
was a difficult one for education compliance.
So, yeah, it takes a while for things to settle out. So we will look at all of this before we're done. Any questions, Patrick?
Hopefully I'll have more concrete figures for you next time. So
Okay, maybe
work in
we'll have more
progress.
concrete wording for.
it's a work in progress.
Okay. And next, we have Jake Feldman. Is that going to testify?
He's gonna come for the next bill on your wall,
Oh, okay, I've got him on both.
and then I can release me.
Oh, okay, you're on this one, okay.
Jake Feldman, tax department. Do you want me to only talk about this tax, or because the testimony is about past 282 and 286, and there's a few different tax ideas and them?
What's your time like?
My testimony is really short. And
I mean, if you could stay and do the second one, but if your time is short, this is a lot for us to wrap our heads around. I don't know if we can wrap our heads around what's the second? Our schools, all right, meals and room. Meals and rooms is a little easier to understand, so yeah, if you want to do both at once. I
okay,
think we can scratch that one.
okay. So thank you, Jake Feldman, tax department. There's a short handout under my name on the committee page. I am going to talk about a few different things, but mostly about the wealth proceeds tax. But I'm going to start with, in S282, there is a proposal to have a new non-homestead residential property tax classification and a tax that goes with it. And I would just like to give the committee a heads up that that was included in Act 73.
Yeah.
But it was contingent on the school districts being. And
Yeah, I
we,
think that part, we've got, I think, 3 bills in here asking for that. And it is part of. It is set up in 73, so I don't think we're
right
going
there.
to take that up.
Yeah, so it's not a crunch time at all. We wrote an implementation report that I linked and you should check it out.
Yeah.
Yeah, Ways and Means is working on it right now. Okay, so then that's maybe easy to talk about. There's also an income tax surcharge in S282. And I wanted to point out a table that I've shown the committee before. Basically, Vermont already has pretty high income taxes on a very small population of high earners. In 2024, there were about 1,300 residents who had over $1 million. And then if you look longitudinally, there's very few people who have that level of income year over year. It's about 10%. So maybe
Percent of the 1,300.
yeah, so maybe 130. We're making over $1 million every year. Yeah. This is really important. These people keep talking about Massachusetts. Massachusetts instituted a 4% surcharge on income over $1 million. And if you look at my table on the right, it's about, for people who make $10 million a year, how much do they pay? And you'll notice that Vermont is higher than Massachusetts, even including the surcharge. And you wonder, how could that possibly be the case? Well, our top marginal rate is 8.75, but it starts at 350-ish thousand of income. Massachusetts is 9%, but it starts at $1 million. So if you kind of imagine 2 lines going out, it takes a while to get to the point where your taxes are actually higher in Massachusetts. If you're a run-of-the-mill millionaire, you're already paying a lot more in Vermont. You have to be like around, I don't know, 11 or 12 million before you get the paying more in Massachusetts. Okay, so that's income taxes. Meals and rooms taxes, similarly, were already pretty high in the region. I wanted to really do a good study of that for you guys today, but I couldn't. My Googling was not fruitful enough. So I found something from JFO. Meals tax, our 9% is already #1 in the region. So that includes New England and New York. And then our rooms tax is tied for #2 is Connecticut. So we're already pretty high there. If you have something about overall affordability and taxes, Madam Chair, we would love to do like a more holistic
I think
discussion.
that might be helpful. I do remember when we were looking at the surcharge on short-term rentals. I was concerned that doing some short-term rentals and not all of them might be a problem. And we were told if we did it on everyone, we would be the highest in New England, and that wasn't a really good place to be when a significant amount of your state revenue depends on tourism.
Right, yeah, so that's not including the short-term rental surcharge, which is 3%. So, yeah,
Thank you.
Okay, thank you, Madam Chair. Jake, aren't a lot of these folks in this bracket gonna be getting quite a few tax cuts in HR1? So isn't this kind of like balancing it out? And the other states that you're mentioning, do you think they're gonna be instituting something similar in response to HR1?
similar to what?
Similar to what we're like doing something in response to try to claw back some of the money that they're gonna be losing.
I think, states consider surcharges on income or maybe even, well, the wealth proceeds tax is more exotic. Although Virginia is looking at it, but states are in a competitive environment with each other. So when you have something like HR1, there's going to be some Vermonters who benefit, but there's, no matter what state they're in, they benefit. So if one state says, oh, well, let's try to take that back. Let's try to take that tax capacity back. They're at a disadvantage with respect to all the other states.
we know. Because there's been a tendency to say rich people are going to do better than middle class people under the tax cuts. And they are probably as a general class. But it's a logical fallacy to say some are, therefore all are. I don't remember the last. If we knew which groups of rich people, or are they all, is everybody? I have a feeling some of the people in that bracket may be active business owners now who are providing jobs, and some of them are retirees with really good investments. Some of them might even be veterans that got really good jobs after they retired. There's they're not a homogeneous group. And we've already heard in that top bracket, I think it's 50% in and out every year. I mean, it's a lot of churn in that top income group.
Yeah, I'm on the effects of the federal legislation, I'm not totally sure.
Okay,
I've heard anecdotally, probably like you, that it's going mostly to higher income
Yeah.
people. But I haven't seen like a quick study on it.
yeah, so
So
I
I'm not
remember
quite sure.
the last one, most of the benefits went to if you owned a business partnership kind of thing, and there were a lot of tax depreciations and things you could do. But if you were just working for a salary with the SALT exemptions, you did not make out so well. If you didn't make out poorly. So I think it's because that top bracket is so wide in this state, it would be helpful if anybody could help us figure out who exactly, is there one group that's there?
Yeah, no, that's a good question. I don't know for sure. I know that they expanded the SALT deduction.
Yes, they did.
From 10,000 to 40,000, so that's gonna benefit like my family, for example. Because our property taxes are already 10,000, so now we can take our income taxes to it, that will become itemizers.
That will benefit a lot of Vermonters whose property taxes are over $10,000.
Yeah, potentially,
Yeah, mine are here.
yeah, so that's a good question. So onto the wealth proceeds tax, or the net investment income tax. The only other state that has this is Minnesota. And I hope I'm not fudging this, Pat. But the rate is only 1% in Minnesota, and I think it's only on investment income that's over $1 million. So it's not that you have to be a millionaire, it's that you have to have $1 million of that income. But I could be messing that up, but I think that's what I read. So the bill that S-282 would be 4%, and it would be on any investment income, no matter how much you have.
If you make over 200,000 a year.
Yeah. If you take a look at your tax returns from last year, you'll probably notice that you have some of this, like qualified dividends. Or you'd see it on your 1040. So, regular people may be subject to this. I will say also that the federal rate is 3.8%, and for Vermont to go higher is unusual. Usually Vermont, when you're looking at federal things, you use a rule of thumb that Vermont taxes are about a third or 30%. So if you look at a lot of our credits, they're like 27% of federal or 30%. So to have something that's beyond what the feds are doing is a little bit unusual.
And this isn't a tax that was cut in HR 1.
I don't think there are any changes to this in
Yeah.
HR 1.
I haven't heard any mentioned today, so
Yeah,
this isn't the area that benefited.
not that I know of. It may just be a drafting thing, but we noticed that the thresholds on an S-282 are different than the federal thresholds. It's based on Vermont taxable income. So that would create a situation where you are not subject to the tax federally, but you are in Vermont, which would be pretty confusing, or vice versa, and that's not great. So that's just a technical thing. We've been talking to JFO about how you would do a apportionment for this. It could be pretty complicated. Apportionment is where like you look at your income and you say, where's it from? Is it from Vermont or from somewhere else? And we just don't know how this would play out, but it would need its own apportionment schedule. So that's a complexity. If the feds do repeal this tax, like if they perk up and they say, hey, states are trying to create a wealth tax out of this thing and they repeal it, then that kind of leaves any states that have it in a tough spot. You have to kind of recreate it all, which could get quite complicated. My most important point is the very last one on the page. Vermont has a lot of the revenue from this would come from capital gains, as Pat mentioned. Vermont has a 40% capital gain exclusion. Why? The reason that it has such a generous exclusion is because it's an acknowledgement that we have really high tax rates. And for people who like shepherd a farm, own business through 15 and 20 years of development, when they go to sell it, Vermont doesn't want to penalize them. They've been making not a lot of money each year, but then one year all of a sudden they make a couple $1 million because they sell their coffee roasting business to, a local or regional fancy food distributor, right? So that's why we have it. This would tax that. So it doesn't make sense for Vermont to exempt something in one spot and then tax it in another spot. That's a problem. So there needs to be some thought about what's our goal here and how we treat this kind of income. It drives me crazy that Vermont has an alternative. This is a little bit of a tangent. Vermont has an alternative minimum tax. It's 3% if your AGI is over 150,000. But what it does is it taxes people's medical expenses and it taxes what's called bonus depreciation. It's like when you buy a piece of equipment, you have a different depreciation schedule than the feds with the add in the beginning, you get this track later on, but it's a tax on those two things, right? So if you're going to say to somebody like, hey, you have extraordinary medical expenses, we want to give you a deduction for them, fine, but don't tax it in a backdoor way, right? So we've tried to get it repealed by ways and means to not fight. But it drives me crazy because it's really inconsistent, and this also would be inconsistent too. It's saying, we have a capital gains exclusion for you, hey, person who developed like a pod for breastfeeding in airports, you nurtured your business for 20 years and now you have this capital gains exclusion. But, oh, look, next page in the booklet, you're taxed on that same capital gain. It doesn't make any sense at all. So that's something to think about if you keep talking about this kind of tax.
This is something that we've certainly heard before. And it's a question almost of whether or not Vermont needs to have a tax fairness and consistency standard.
I
which
thought we
would
were gonna
look
say commission.
at the various things that we do and say, are they consistent with one another, or are they counterintuitive, not just counterintuitive, but counter-effective? We have to look at taxes as a whole. We look at this one and that one and this one over here.
This, I think we're in some ways and means. We don't always agree, but I think we are definitely going to look at this because we make decisions on income tax and don't look at how that all interplays. We spent one whole year when the feds were doing inheritance taxes because everybody used to just piggyback off the feds and then the feds played with it. And but to sit back and look at the whole picture, and that's I've had two hospital executives in Ways and Means. Or Health and Welfare, tell us that. The cost burden, the tax burden in Vermont is making it very difficult. For them to attract doctors, especially up to the rural areas where your average patient is on Medicaid. So we're gonna have a whole school where you will do your residency in Vermont, and the hope is you'll stay here. But if you're gonna make less and get taxed more, that's not that. I don't think you want your tax policy to do that, so. We'll, this might be a good opportunity to kind of look at the whole picture rather than just playing off of wealthy people made out better by HR one, therefore we will tax wealthy people. We get really upset when they say that about poor people and SNAP benefits. It's the same fallacy. To say some are, therefore all are. And we'll try to avoid that. Let's see where we go. Okay, any questions for Jake? Thank you. Okay. That ends 282 for today. We're gonna do 286, and that Ken is doing that, not.
I walked through state for the biggest, I can.
Okay,
give you a
I thought
refresher.
so, we had looked at that. Okay, so we will go. So Ken, are you, I've got Patrick on here, but I gather you are Patrick today?
I am Patrick today.
Okay.
Yes, I was praised it that way.
I got you both on both, but I gather it's one on one.
That's right.
Jake's already been, so you're it.
Great, then I will sit in the chair.
All right.
Oh, sorry. I was expecting Kirby to go for a little bit of time. I have a document that is posted to the committee page. Would you like me to share my screen?
Yes,
Great.
because then everybody can see it and people at home can see it.
Perfect. Well, then
They might not all have the committee page on speed dial.
that's fair. All right. Well, it'll take me 20
Okay.
seconds to hop in the Zoom in that case.
We are so ahead of time. We might get a 15-minute break. And all my meetings today got canceled. I'm feeling rejected. No, I'm not caught up in my emails. That's what I'm staying here doing tonight. I'm still working through the Supreme Court. emails. Okay.
Okay. I think I am. Okay. Zoom in a little bit. Okay. So, brief version of the walkthrough. This puts a 2% surcharge on the Meals and Rooms tax base. It allocates that revenue to the school construction aid special fund. Just the general reminder of the general Meals and Rooms tax. Under current law, the allocations are 69% to the general fund, 25% to the education fund, 6% to the clean water fund. And the education fund receives 100% of that 3% short-term rental surcharge. In FY25, the total Meals and Rooms tax raised $262.3 million, including the STR 3% surcharge. I wanted to also put together a table that shows how the tax rates on different aspects of the Meals and Rooms tax, what they would look like with the 2% surcharge. So meals would go from 9% to 11%.
alcohol, rooms would also go from 9% to 11. Short-term rentals would go from 12 to 14% and alcohol from 10 to 12. And then you can add an extra percent to those calculations for towns that have a local option. If we're thinking about rates, did also want to note that Burlington and Rutland have special provisions in their charters to do their own, they call them gross receipt taxes. And when you layer that 2% surcharge, for example, on Burlington's 4% on hotel motels, the tax rates, you know, thinking about competitiveness in comparison to other jurisdictions are getting relatively high compared to our neighbors. In looking at some preliminary revenue estimates of that 2% applied to various aspects of the meals and rooms tax. And this is looking at the base, removing the short-term rental surcharge. We are estimating that in total in FY27, 2% would raise $53.1 million. It's a first year implementation. In the first year, right, you need an extra month to account for the tax change. And then in FY28, the total revenue raise would be, I think, a flat 60 million estimated. Noting that 100% of these revenues would flow to the School Construction Aid Special Fund, which was created last year in Act 73. The special fund does not currently have a dedicated revenue source. And then the next bullet outlines the envisioned set of awards for school districts for aid in school construction. Base awards would be 20% of debt service costs. They're bonus incentives. Chris is in the room and you might know a little bit more about those bonus incentives, but that would provide up to an additional 20% of debt service costs. And then there's also a provision for emergency needs within the special fund. So wanted to provide a little bit of context for what the revenue might be used for.
Okay. Where would this put our tax rate in comparison to the surrounding states? Like New Hampshire, Massachusetts, Maine, do we know that?
It is, so Jake, I think, mentioned that the meals tax, I think, is pretty much, for 9%, we're pretty much the highest in the region. I can provide, I have a summary table that I would be happy to provide for the rooms portion, lodging taxes in different jurisdictions. Those, it's harder to apply kind of blanket competitiveness statements because independent jurisdictions, like New York City has their own specialized rates, Boston has their own kind of regime. So I have
museum fund, waterfront redevelopment fund,
exactly. So I have a couple tables
not
on
long in some cities.
totally. So I can provide a couple tables for you all to see
Okay,
how
but just, I mean, just the general statewide rate, unless, I know New York has regional sales tax. I don't know they have regional rooms and meals. But Maine, New Hampshire, Western Massachusetts, leave out Boston. The places that would be more competitive, lots of trees, lakes, no building. To see what that would do for us, I am sure the minute that's on the board, we will hear from the wedding planners. We heard from them last time. But that's one place where you have it's a really big number and it's laid out and it's a highly competitive business. They were impressive when we were doing this for the short-term rentals. So we will see where that goes. Then you're Matt knows.
Ted, I don't know if you would have the information for this, but are you able to parse out Vermont residents versus out of state?
there ACCD has some tourism market research. And I can certainly take a look at that, and they have spending in state, out of state, and see what the split would be. Right, it would be different in different categories, right? Your meals and alcohol would be much more resident based, whereas the rooms is much more reliant on out of state
And that's
tourism, understandably. But yeah, we can definitely, I can provide that information with ACCD to help frame.
Yeah, and I've got ACCB to come down and talk to us. They too were probably lining up to volunteer as we speak. It's just our past performance. Okay. So, I don't know. Yeah, we'll have to wait for it. Committee. Questions for Ted? Anybody you would like to hear from on either of these bills? I've got the CPAs with the top one.
I know in the past, maybe not this, the owner of One Day in July,
Dan.
Dan Cunningham. He deals with, a lot of clients that are in the categories that we're talking about.
He did a
Get
presentation.
contact information
I'll get his email for Charles.
for Charlotte, see if he'd be willing to come talk to us.
Okay.
Okay. Hey, committee, I'm gonna give you a whole 10-minute break.
I got a chair, thank you.